This is Insider Interviews with Epok Advice, where we sit down with some of the industry's leaders and hear about their vision for the future. Today, I'm thrilled to be joined by Kendrick Wickman, a true veteran in the financial services and fintech world. Kendrick has spent more than 30 years operating at the cross-section of investment management, wealth management, financial markets, and technology. He's the co-founder and CEO of WealthTech Strategy Partners and previously founded FinMason, where he led the development of one of the industry's most powerful investment analytics platforms. Kendrick's career spans leadership roles at both major institutions and high-growth startups, including Lazard Asset Management, Kovia, and several advisory boards across the fintech space. A CFO, charter holder, founder, and no-nonsense thought leader, Kendrick brings an exceptional mix of vision, execution, integrity to everything he does. I've certainly benefited from having him as a thought partner, and we've known each other a long time. Really looking forward to delving into some of his insights. He's certainly got a front row seat on WealthTech today. So Kendrick, welcome, and thanks for joining me today.
Well, thanks for having me. And that intro was, especially coming from you, is incredibly flattering.
Thanks. I find the intros to be hard because what I want to say is all the different ways that I know you or I've learned from you or what I've observed, but I have to get the basics out too because not everyone knows us already. So let's start there. Tell me how you would introduce yourself or where and how you got to be where you are today. What's your background and what's your focus?
Um, well, I mean, as you pointed out, I started with a 30-year career on Wall Street. Was always very interested in technology. In fact, I was thinking about this the other day. My first wealth tech program I put together was in probably 1988, and I was a assistant to a broker at a broker dealer. Back in the old days when they just you know traded stocks. And he had one big client, and the client was very tradey. And I actually took my little Mac Model 1 from college and did a spreadsheet with his portfolio and then just updated the prices and the units for all of his trading, printed it out, and we faxed it to him at the end of the day. He absolutely floored him. I mean, there just was nothing like it out there. And so we ended up increasing wallet share significantly with the guy just because he likes seeing these little summaries at the end of the day with his daily performance. And I went back to college. I was there on an internship, and they actually bought me a fax machine to keep in my dorm room so I could keep printing this thing out. I mean, that was the state of technology back then. I know people don't believe it, but that's what was going on.
I still see some fax machines in my travels. It's pretty scary now when you see it. You have the opposite reaction. It's not innovation anymore. It's a sign of stagnation, right?
Yeah, yeah. Well, you never know. But now one thing led to another. I started a wealth tech firm, FinMason, as you mentioned, and now I run Wealth Tech Strategy Partners. We are an investment bank, basically, that focuses exclusively on wealth tech, which is a little strange. I don't think anybody gets that specific, but it's a niche we know. It's a niche we like. It's the people we like to deal with, and kind of almost our social group, really. So that's where we like to hang out.
Yeah. And you and I had a great conversation after I saw you last in New York, where we talked about some of the things you've been observing, both that drove the genesis of the firm, but also where you're putting your focus with clients today. Describe what you think is happening as it relates to transactions and activity within the wealth tech space and why a focus partner like yourself really helps in that context.
Yeah, well, we like to deal with a lot of earlier stage companies, and so with the earlier stage companies, it's really about where can we get funding, where can we find a strategic exit, and the funding side is actually very, very tough right now. Funding continues to be down for early stage wealth techs. It was down from $400 million in Q4 of last year to $283 million in Q1 to $200 million this quarter. And that, of course, is all down substantially from the heydays. So uh, the VCs continue to be very selective about where they put their money, especially with the new name. They've been having trouble raising money themselves, so um, they're saving a lot of capital for their winners. We're also seeing them play more in larger deals. So, above $100 million deals in WealthTech, they're actually getting funded now. There was 500 million of that in Q2, up from about 135 million in Q1. So the bigger deals are getting to play, and part of it is because of the VC dynamic where their funds are getting a little long in the tooth. They need to get their money back to their investors sooner rather than later. So they're looking for later stage deals. We're seeing them in B, C, D deals, where we typically wouldn't see them before. So not so great on the funding side of things, I'm afraid to say, for early stage companies, but the strategics are doing minority investments, which they typically have shied away from them in the past. I just tell people, give it a little more time. It's going to take longer to get done at the strategic level because you've got to sell your product and sell the opportunity. Um, and of course, the strategics are very aggressive on the acquisition front right now. They're all in a big headlong race to plug all their feature set gaps, to pull as much forward on their roadmap as they can. And unlike the old days, making acquisitions now is kind of a pleasure because you're not acquiring on-prem technology that's difficult to integrate. You're acquiring clean tech stacks, cloud native, API first type things that are easy to integrate, so you can really accelerate your time to market.
Yeah. And this whole thing of the rise of transactions with strategics has been interesting too, because what we're finding, at least in my travels, I'm finding the in-house technology and innovation teams are getting quite good at spotting where there's something sustainably differentiated that they couldn't replicate, or where they already have something on their stack that could be expanded or pointed towards a new use case. They're getting to be very good collaborators to the wealth tech founders, so they're able to really think about not just being a strategic and as a way to get something out the door, but actually to be a partner, a thought partner, or an expansion partner. Talk to me a little bit about how you support that type of matchmaking, or understanding how to get the right strategics into a conversation with a wealth tech firm.
Well, we like to keep our finger on the pulse of what's going on in the industry, which is one of the things that being a specialist in the industry allows us to do. And so we just try to make things as efficient as possible. We try and make it a point to understand who's got what pain points out there, where everybody's trying to go in life. And then we try and keep a handle on all the solutions and which ones might be good fits. So, a lot of the times when we take on a mandate, we kind of know who's probably going to play before we even pick up the phone. And that just makes things goes a lot easier at the end of the day with a lot more focused effort. It is understanding the nuances of the product are incredibly important because a lot of the times we're dealing with companies that aren't necessarily revenue numbers play. I mean, if you're doing, $50 million in EBITDA, I mean, any bank can take you, shove you in a financial model and kick you out the door. But, if you've got a lot, earlier stage revenue, understanding those nuances and what it actually does for an acquirer is incredibly important. Um, so, our contacts and our understanding of the industry, and helping to get that story and tease out those details is important. Um, Apart from that, it's a lot of normal banking stuff. Like right now, the strategics, although they are aggressive at buying, they're bidding low. And the reason why is because, they look at the funding market. They're like, well, I don't know, what else are you going to do? At the end of the day, if you don't have multiple bidders, you're just going to have to take the price that's on the table. That's it, or walk away. And it's sometimes both those things are pretty difficult. But that's what I consider normal banking
Yeah.
stuff.
And when you think of what you've been seeing in your travels as it relates to actual wealth tech capabilities, or the direction that they're going in with their innovation, what gets you most excited, or what are the things that you're really noticing that are going to be the focus of your and my time over the next few years?
Well, I mean, we have a whole bunch of themes, that we track. They're on the front page of our website, so we're very open about our thought process. But I would say kind of the two that are like really stand out to me is one is the whole family office as a service theme, where I think people are going to be using technology to try and scale some of those high touch, low scale services that you find in a family office and bring them down AUM through the use of technology. I think that's going to be a very popular theme. It has proven to be a popular theme, and I think that's got a lot of legs to it. One kind of, out of the, at least kind of maybe a newer theme in the wealth tech space, although it's been around for a while, is TAMPs. And that, private equity has taken a very distinct interest in TAMPs these days. We get a lot of inquiries from private equity about what to do with the TAMP space. Um, but having just come back, I spend a month in London every year, just trying to learn the market over there better, and generally foist myself on the European wealth tech scene. And one thing that strikes me is they are pretty far behind us in where TAMPs are at. They don't call them TAMPs because they like to be difficult. They call them MPSs, Managed Portfolio Solutions. But the adoption rate is much lower than in the United States. The technology adoption rate at TAMPs, MPSs is pretty much non-existent. So I think
Right.
those two things are going to be absolutely on fire over the next 5 years um, for anybody who fancies a venture over in the UK.
That's awesome. And what do you think is the most common thing that you're seeing founders or um, more robust wealth tech leadership teams struggle with? What are you seeing that they need help with and could benefit from either an outsider perspective or just even a peer perspective?
If you're a founder and you're growing a company, it's really nice to have these well thought out thought processes, et cetera. And, you know, but the reality is you're in a running knife fight. And, sometimes sometimes like getting all that good thought clarity around stuff gets pushed to the wayside. So I'm not faulting founders on this at all, but we do feel like a lot of the times the go-to market strategy is it's more intuitive than well thought out and researched. Sometimes the playbooks really are again more intuitive than systematic or scalable. So I would probably say the big challenge usually comes in sales and the whole go-to-market strategy, thinking about what makes sense, really paring down the pitch to what works for who, and treating that like a traditional sales effort at a larger organization where you have more time to think about this stuff. I would say that a lot of founders would benefit immensely from that sort of a thought process. Hopefully early on in the process. But again, I'm not faulting them because I know what it's like. I built a firm. These are kind of the things that you chuckle at and say, well, that's really kind of cute that you think that way,
Yeah, I
Kendrick.
wish I had the time, Kendrick. I wish I could
Yeah.
do that. I find, like today alone, as an example, I had two different teams in my morning schedule where it was like, what you're describing is so awesome and so out of sync with how people are looking to buy. It's like you need a decoder ring or some way of taking the capability you've built, but pivoting the story so that it's more aligned to like the buyer's actual articulation of their issues and the way they're going about it. It's amazing how often I see founders who do an exceptional job talking about the technology, but very little diligence has gone into thinking about, well, what's it really taking to buy this? Who's really buying it? What's motivating them? So that's a great example too that I see a pattern around, like definitely needing help there.
Yeah, yeah. Like the first thing I say to people is, I'm like, ditch the demo. Don't lead with the demo. Sit down, talk about it, because once they get into the demo, it usually goes downhill pretty quick. If they're not leaning forward, like by the time they start the demo, they're not going to be leaning forward by the time they end the demo. It's people, especially founders, they get way too into the weeds. They take a look at they get all excited about these little feature sets that and somebody's going to buy the product really for like one, two, or maybe three reasons. Make sure you handle those first and just sit down and have a conversation. Like, let's just talk about where you fit in, the problems you're solving, how you're solving it, like what differentiates you, that sort of stuff. You know, I'm like, I'm gullible. I'll believe me. I'll believe you if you say that you've
I'll
got
believe
like
you.
a
No,
really,
you don't need a
you
demo. I'm going to keep that in my talk track now. No more demo. But the other thing that I really get surprised by, and I've been doing a little bit of market entry work both in the US and in Canada for vendors, is how little context around adjacency and the context of the stacks that exist. So, like for me, you're trying to be the capability of choice for a specific set of needs on an existing stack. To me, it's very intuitive to me anyway to be like, well, what's already on the stack and what are those vendors saying they can do and what is the integration or the data or the overlap that I might bring to the table if I were to win this client over. So a lot of times I find I'm like, well, how are you going to do this pitch if we don't know what else they already have that they've been already told can do exactly what you're saying you can do better? Or the other thing that I notice is sometimes founders get very myopic on the biggest fish doing something similar, and they miss the other quick and nimble players that are catching up to that big fish. Sometimes it's like turning the lens slightly differently to help them see the full picture.
yeah, yeah. Well, like I say, it's not. I'm not faulting them because like a lot of times
Yeah,
it's hard to just take a step back and have these like I'll call them luxurious strategic thoughts. Uh, you know, when you're building a business.
totally. So you mentioned research. It's one of the things that I've really enjoyed is consuming the research your team's producing. You've got a great team. Talk to me a little bit about the research agenda and where you're putting the focus on for your next report or next piece.
So I think our very next piece is probably going to be on TAMPs, and we're doing a paper that's going to be published over in London on the MPS market. I think we're going to give a good push over there, and we'll probably have one a similar one on the TAMP space here in the United States as well, just because we think that's a really interesting space. We do have, like I say, a bunch of themes that we write on from now and again. It's, family office of service, self-directed trading, as lead gen. We see that as kind of an interesting development. You know, we love talking about next gen because I always love pointing out that I'm the next gen. It's not the kids like, protesting in college. It's me. Anybody who passes away at 85 these days, their kids are probably 62. So um, anyway, prepping for peak 65, we got that huge thing moving to so that's going to be interesting to see how people pivot a little bit from the accumulation phase to making good, compelling proposals on the distribution phase. And of course, you got AI in there and, the alternatives getting into wealth management, all that sort of thing.
I'm trying to kick off a piece right now on the emerging advice appetite from like the youngest investors and whether or not there's a shift. We saw a shift in the millennials, but it was really more a timing shift than a preference shift as it related to core advice. Anyway, I'm doing a bit of work with one of the Canadian universities on that, and then also really trying to do a deeper dive on what are the use cases in AI that are actually past the ideation and piloting stage that are actually starting to become common. And then I've since probably a couple of months ago become really interested and focused on this notes versus CRM debate that's gone from being notes as additive to CRM now to maybe there's a risk here. So I'm like, what's the way to get that data right? Trying to unpack those themes. There seems to be a lot of new thinking emerging, right?
Yeah, I mean, I love that space. I unfortunately can't talk about it very much because we've got an active deal in that space, yeah, as we're speaking here. So I have to be a little
Yeah.
careful what I say. But I think the most exciting thing is that I guess penetration doubled or something like that year over year of these note taker tools. But that's not the really exciting part. The exciting part is it doubled to like 17% or something like that. So it's quite clear to me that there's a lot of room for running there. And the only thing really holding it back are some of the larger firms where the compliance departments are a little woozy about it, but so they tend to be blocking it at some of the larger larger places. But it's not going to be long before the compliance teams are going to be actually demanding it. They're going to, my prediction, they flip 180 degrees, and they're going to be like,
Yeah.
no, you have to have a note taker now.
Yeah.
So
Like the marketing teams flipped on social. Remember, it was like no social. Now it's like get on social. I'm like, guys, you
yeah,
really
exactly.
there's whiplash there. Um, so what gets you, worried, or what are the red flags that if you were sitting talking to a founder or a CTO or the head of innovation at one of those strategics, but what is something that you're seeing that is a pattern that ought to be broken or needs to be challenged to help everyone capitalize on what's actually going on the ground?
Yeah, well, I mean, I do feel like a little more thought, a little more research around the pain points and whether you've actually got product market fit is
Yeah.
important. And but I think that people go about that kind of the right way. I mean, they go out and the typical startup sequence in wealth tech is you get your product together, some sort of an MVP. You go out and you try and market to the smaller RIAs, folks, who can put something on their credit card and get that, gets those early sales done, with a kind of a 30-day turnaround or something like that. And build that way. And it's good because you feel really good. You're like, wow, we're winning business, we're closing deals, this whole thing's going to work, et cetera, et cetera. But the main thing that you really want is you want to show that product market fit, so that you can kind of take it to the next level. Because without that, it's going to be really hard to get VC funding, and it's going to be hard to get into the enterprise area, without that product market fit. Um, so that's the right path to take. The problem is, once you get up to like 300, 500 advisors or something like that, at some point it starts to plateau, and you're like, wow, I can't continue growing like this by just accessing the small independent RIAs. I've got to flip larger. And that's usually when we get a call from people, because that means now you're going to the larger sale process, which is now instead of 30 days, it's 18 months. And you've got to somehow fund that gap. And that's kind of what a lot of times when we get involved. But so it's the right process. I wouldn't say it's a bad process at all. I just, be going in eyes wide open, and if somebody says your product isn't good for these reasons, just please listen to them, and don't say, well, that guy doesn't know what he's talking about, but because they're the users.
Yeah, it's hard, right? When you meet someone who's so convicted that they're not hearing the no's, there's a little part of you that's like, that's so awesome because you may actually be able to burst through and have the stamina to actually make this happen. But then when you're also thinking, no, hear the no. I think it's important to understand what they're responding to and what they're not responding to. So, yeah, it's a little bit of the very thing that makes them great founders is the very thing that sometimes is a limitation. The other one I notice is just the lack of awareness of whether they truly are enterprise ready. So that story you just told, it is not true that just because you can individually sell to 300 advisors that you're ready to do an enterprise deal with a large network of advisors. There's different things, there's different gates, there's different buyers. So that whole translation is often underestimated. And again, that makes sense why you hear from them. It's also why we hear from them, I think, because it's like, oh wait, there's a piece of this puzzle I haven't really planned for. When you think about the sort of epicenters of wealth tech in the US right now, like where are you seeing concentrations of founders? Where are you spending time?
Geez, I do not see concentrations of founders geographically, per
Okay,
se.
interesting.
Uh, it's the whole COVID thing is like got everything everywhere these days. Now
Right.
maybe that's like, you and I, we've been around for so long. We remember when everything was in like, New York and San Francisco, and so now it just seems like everybody's everywhere. I mean, I'm trying to think of uh, like we've had two clients in the last this year, that only two that have come from San Francisco. Georgia, we've had a bunch of clients. I don't, you know,
Yeah.
I don't know what it is. Maybe I just like the people in Georgia more. I don't know, but it's
Well,
like,
we had Tommy Marshall on actually, Kendrick, and he was, he's such a leader in that Georgia fintech space, and he was talking about a lot of the momentum that they've had, and specifically like having an original focus on payments, and then now really turning attention more broadly to wealth tech. But the thing that I thought was interesting is, they've got a small enough street, a small enough community where they've got those strategics, they've got those universities, they've got them all in a hub, which is what it was like in New York going back to the aughts, right? Like, you had the concentration in New York, different than the one in San Francisco, was really about deliberately bringing everyone together to like labs and incubators and what have you, whereas in San Francisco it was much more like a traditional founder startup mentality. Anyway, he was describing Georgia and talking very highly about the caliber, the talent, and the accessibility of the executives on the strategics. So maybe that's why you're noticing it, or maybe you just like Atlanta. So, final thoughts, future of advice. Why is it important for you and I and our teams to be focused on building the future of advice?
it's such an interesting area. I mean, with all of the undercurrents that are happening, demographically, with the evolution of the advisory model, which is evolving rather rapidly, at least in terms of financial institutions, rather rapidly, and the intertwine of technology all around that. Um, that's what keeps us, in this area, even though some people might consider it a small pond. It's a pond that we really like, and there's always something interesting happening. So, and we've got a highly fragmented market, so there's a lot of moving pieces to it. And every time we sell a company, another two seem to take its place. So I'm not sure we're doing a very good job of consolidating the map down. But at the same time, it's the consumers are very fragmented. So it's not just that the vendors are fragmented, the consumers are fragmented. So that one killer product that would normally sweep a marketplace and cause a lot of consolidation on the vendor side, it doesn't really exist. So everybody wants something different.
Well, thank you very much for joining me today and for spending time. And thank you also for being such a good friend and cheerleader of Epok and what I'm trying to build. I've really appreciated getting a little piece of your time and consuming your thought leadership. And I'm looking forward to hopefully bumping into you at some sort of event or two next year. Until then, thank you very much, Kendrick. Thanks for being here.
It was my pleasure. I enjoyed it. Thank you.
Our conversation with Kendrick today was a great reminder of just what it takes to be a wealth tech founder and why having partners that really understand the space and are able to meet you where you are matter and make a difference. I loved his thoughts on strategics and just generally loved that he believes so much in the space that he's willing to build a whole business around supporting the investment banking needs of wealth techs and strategics.